Now let's take up diluted earnings per share for the objectives to define diluted earnings per share, to identify potential ordinary shares, to distinguish dilutive from anti-dilutive securities, and to identify the formula in computing diluted earnings per share in relation to convertible bonds payable, convertible preference shares, and share options or warrants. Now, in chapter 19, mention was made about the two types of earnings per share, basic earnings per share and diluted earnings per share. Now, with the diluted earnings per share, we have to consider anti-dilution and dilution. Now, when the capital structure of an entity is simple in the sense that it consists only of ordinary share capital and non-convertible securities, the computation of the earnings per share is easy. The net income minus the preference dividends is simply divided by the number of ordinary shares outstanding or by the average shares outstanding, whichever is appropriate. But where the capital structure of an entity is complex in the sense that it consists of ordinary shares and potential ordinary shares or potential diluters, the computation of the earnings per share becomes a little complicated. Now, a potential ordinary share is a financial instrument under contract or other contract that may entitle the holder to ordinary shares. A potential ordinary share is a financial instrument that represents future issuance of ordinary shares. There are three major types of potential ordinary shares: convertible bonds payable, convertible preference share, and share option and warrants. Now, for dilution, arises when the inclusion of the potential ordinary shares decreases the basic earnings per share or increases the basic loss per share. In this case, the potential ordinary shares are dilutive securities. Anti-dilution arises when the inclusion of the potential ordinary shares increases basic earnings per share or decreases basic loss per share. In this case, the potential ordinary shares are anti-dilutive and ignored in computing diluted earnings per share. Diluted earnings per share. The computation of the diluted earnings per share is based on the as-if scenario. As if the convertible bonds payable is converted into ordinary share. As if the convertible preference share is converted into ordinary share. As if the share options and warrants are exercise. So now we go to the problems. At least we will be able to uh, identify the computations of diluted earnings per share. Loan company reported the following at year-end: bonds payable, then ordinary share capital, and net income. The bonds are convertible into ordinary share in the ratio of 10 ordinary shares for each 1,000 bond. The income tax rate is 30%. Now we compute for the basic earnings per share by dividing net income by the number of ordinary shares of 50,000. In number 2, compute for diluted earnings per share, the ordinary shares outstanding is 50,000. Then we have the assumed issued ordinary shares through bond conversion. So we have 1,000 multiplied by 10. Because, as stated, the bonds are convertible into ordinary shares in the ratio of 10 ordinary shares for each bond. The income tax rate is 30%. So if you have now your ordinary shares, that will be, we assume that the ordinary shares will will arise due to bond conversion, that for 10 ordinary shares, you will be receiving, or for 1,000 bonds, you will convert this to 10 ordinary shares. So if you have now the bonds payable equal to 1 million, and then if we divide this by 1,000, we will have 1,000 shares, 1,000 bonds payable, and then we multiply this by 10 ordinary shares. In other words, you will be converting this to 10,000 ordinary shares, so that the total ordinary shares is 60,000. Actually, you will convert the bonds payable. So for every 1,000 of bonds payable, you will be issuing 10 ordinary shares. So there are 1,000 in 1 million. So meaning for every 1,000 bonds, you will be receiving 10 shares. So this time, the total ordinary shares is 60,000. So net income of 1,730,000. Then we add back the interest on bonds payable. The bonds rate is 10%. That's the interest rate. And then we multiply it by the principal of 1 million. So the interest will be 10% of 1 million is 100,000. And you multiply it by 70%, that's net of tax, or 100% minus 30%. So we now get 70,000, the interest on bonds payable. So the adjusted income is 1.8 million. Now, for the net income of 1,730,000, then we add the interest on bonds equal to 70,000. We have the adjusted income of 1.8 million. And the 1.8 million adjusted income, we divide it by 60,000 ordinary shares, so we now get 30 per for diluted earnings per share. Now in the case of number 2, 20-2, basic earnings per share and diluted earnings per share. On April 1, 2020, River Company issued 2 million 12% bonds at face amount. Each 1,000 bond is convertible into 10 ordinary shares. So that means 2 million divided by 1,000 is 2,000 multiplied by 10. The entity reported net income of 2,749,000 for the year ended December 31, 2020. The average number of ordinary shares outstanding was 100,000 shares, and the income tax rate is 30%. So the basic earnings per share is 2,749,000 divided by 100,000 shares outstanding. So for the basic earnings per share of 27.49. Now in number 2, we will compute for diluted earnings per share. So the ordinary shares outstanding of 100,000. We have now the assumed issued ordinary shares through bond conversion. So we have 2 million divided by 1 million is 2,000. And then we multiply 2,000 by 10. We get 20,000 and multiply by 9 over 12. So we get 15,000. That's the assumed issued ordinary shares through bond conversion. And we have now your uh, total ordinary shares equal to 115,000. Okay, so we now get 115,000 for the total ordinary shares. Then we have net income, and we have to add back interest on bonds at 12% times 2 million times 9 over 12, because the bonds were issued only on April 1, 2020. So that's why we also have 9 over 12 up. So we have the assumed issued ordinary shares. That's why we have only 15,000. So to net income, we add interest on bonds payable at 12% a year times 2 million equals 240,000. But we multiply this by 9 over 12 since the bonds were issued only on April 1, 2020. So 180,000, and we deduct the income tax of 38% or 54,000. So we have the adjusted income equal to 2,875,000. Now the diluted earnings per share is the adjusted income of 2,875,000 divided by 115,000 total ordinary shares. Now we are adding back interest, the fact that in arriving at the net income, we deducted interest on bonds. So we have to add back in order for us to arrive at the adjusted net income, considering that the bonds, you have privilege of converting them to shares of stocks. So in the event that you will convert them to shares of stocks, you will no longer be paying interest. Next, we go to 20-3 with the same requirements. January 1, 2020, Simple Company provided the following information. Ordinary share capital 100,000 shares with 100 par. 12% bonds payable issued at face amount. Each 1,000 bond is convertible into 20 ordinary shares. So we have now 4 million. So you can have 4 million divided by 1,000, you get 4,000, and then you multiply that by 20. On April 1, 2020, bonds with face amount of 3 million were actually converted into ordinary shares. So you still have a balance of 1 million. Net income for the current year is 2,320,000, and the income tax rate is 30%. Now computing for the basic earnings per share, we now have January 1 with 100,000 ordinary shares. So we have to multiply this by 12, arriving at the peso months of 1.2 million. Then on April 1, we have 3,000 shares multiplied by 20. That will give 60,000. 3,000 multiplied by 20. So meaning the bonds were converted into ordinary shares, good only for 9 months. That's from April to December 31. So we have 540 peso months. Total 1,740,000. Then we divide it by 12, the average of 145,000. So the basic earnings per share is 2,320,000 divided by the average number of shares of 145,000. We get 16. Then in number 2, we determine the diluted earnings per share. The ordinary shares outstanding of 100,000. Then the ordinary shares issued through actual bond conversion is 60,000. And the assumed ordinary shares issued through conversion of the remaining bonds, we still have 1,000. That's from 1,000,000 divided by 1,000. So we have 1,000 and multiplied by 20. So you get 20,000. Total ordinary shares of 180,000, including the assumed conversion of bonds of 1,000,000. Since the bonds are outstanding on January 1, 2020, the ordinary shares issued through the actual bond conversion are considered outstanding from January 1, 2020 because, as stated, on April 1, 2020, the bonds with face amount of 3 million were actually converted. Now, so we have the net income of 2,320,000. Then we add back the interest on bonds actually converted, 3 million times 12% times 3 over 12. That's the conversion on April 1, 2020. Then the interest on remaining bonds of 1 million, we multiply by 12%, assumed to be good for 1 year. So 120,000 added to 90,000, total is 210,000. We deduct the income tax of 30%. So we have now the net income or the interest net of tax of 147,000, the adjusted net income of 2,467,000. So the diluted earnings per share is 2,467,000 divided by 180,000 shares. So in case we use diluted earnings per share, we have 13.71 while the basic is only 16. Next, we go to 20-4. In 20-4, required compute for the basic earnings per share and diluted earnings per share. The company has made a net profit attributable to ordinary shareholders of 2 million for the year ended December 31, 2020. There are 100,000 ordinary shares outstanding during the entire year. Since January 2020, there have been 800,000 of 5% convertible loan in issue. The terms of conversion for every 10,000 nominal amount are June 30, 2020, 120 ordinary shares, June 30, 2021, 150 ordinary shares, and June 30, 2022, 140 ordinary shares. No conversion has taken place during the current year. The interest on the convertible loan is allowable for a tax relief of 30%. So in 20-4, leading to determination of basic earnings. We have 2 million. That's your net profit for the year divided by 100,000. That's the number of ordinary shares outstanding during the year. So we have ordinary shares outstanding of here 100,000, and then we have the assumed ordinary shares through conversion of bonds on most favorable terms. So we have 800,000. We divide it by 10,000 because it's for every 10,000 multiply by 150. So we get 150, so we get 12,000. As stated, since January 2020, there had been 800,000 of 5% convertible loan in this issue. The terms of conversion for every 10,000 nominal amount are, so we have now 150. That's on June 30, 2021. Assumed ordinary shares through conversion of bonds on most favorable terms. So most favorable, considering that you have the highest conversion rate. So the total ordinary shares of 112,000. Diluted earnings per share is 2,028,000 divided by 112,000 gives the amount, or the basic earnings per share is only 29. That's 2,610,000 divided by 90,000 shares. So we have 29. The basic earnings per share in number 5, no? While in number 4, we already have the diluted earnings per share equal to 18.11. Now going to number 5, given is net income of 2,850,000. That's for 2020 net income. Then the preference dividends 10,000 multiplied by 24. We have the convertible preference share capital in the amount, or in total of 10,000 shares. So we now multiply the 10,000 shares by 24, since that's the dividends paid on the preference share during the year. So we have now 24 times 10,000. We deduct from net income 240,000, and the net income to be given to ordinary shareholders is 2,610,000. So for the basic earnings per share, we divide 2,610,000 by 90,000 shares. So we have now the total ordinary shares of 110. The ordinary shares outstanding is 90,000. The potential ordinary shares convertible preference is 20,000. So we have now the total of the ordinary shares of 110,000. So diluted earnings per share is net income of 2,850,000 divided by the number of shares, adding the ordinary shares to potential ordinary shares. They have convertible preference. So the total ordinary shares of 110,000. Next, in 20.6, compute for the basic earnings per share and the diluted earnings per share. In 20.6, January 1, Judy Company had 200,000 shares with 50 par. In addition, on January 1, 2020, the entity had issued 30,000 convertible cumulative 10% preference shares with 100 par value. So, going back now to the January 1 outstanding shares of 200,000. Then on September 1, we have the conversion of the 30,000 shares, 30,000 stated. These preference shares were converted September 1. Each preference share was converted into 5 ordinary shares. So we are given preference shares with a total issued of 30,000 but convertible. So we have now the actual number of preference shares supposed to be 30,000. So each preference share was converted into 5 ordinary shares. That was on September 1. So on January 1, the outstanding shares is 200,000. Then on September 1 conversion, we have 30,000 times 5 ordinary shares times 4 over 12. September to December. So the amount of the answer of 50,000. The average ordinary shares is total of 250,000. Then for net income, it was for 20.6. Net income is 5 million given in 20.6, and we have now your uh, shares or preference dividend at 10%. So 10% of 3 million is 300,000. So to net income, we add back preference dividend of 300,000. Then we have net income of 4,700,000. Then for basic EPS, we have 4,700,000 divided by 250,000 shares. So on January 1, outstanding is 200,000. Then we add September 1 conversion of 150,000 shares. The total ordinary shares is 350,000. So the basic earnings per share was computed above 4,700,000 divided by 250,000 shares. That was in 20.6, no? So we have number 2 requirement, the January 1 outstanding shares. Then we add the converted the shares after conversion. Total ordinary shares is 350,000. Thus, we divide 4,700,000 divided by 250,000 shares inakon ordinary. But if we have the January 1 computation now of diluted earnings per share, January 1 outstanding, then we add September 1 conversion at the rate of 30,000 times 5. So we get 150,000. Total ordinary shares of 350,000. So diluted earnings per share is 5 million, the amount of net income. Then we divide it by 200,000 shares. The total option price is 50,000 multiplied by 6. No, however, in 20-6, diluted earnings per share is 5 million, the amount of net income. Then we divide it by 350,000 shares. 200,000 is outstanding January 1, and we just added the other two. So for 20-7, again in 20-7, we have to compute for the basic earnings per share. So we have now given in 20-7, 7.5 million, that's the amount of net income. Then we divide it by 200,000 of ordinary shares outstanding. So we get 37.50. In requirement 2, compute for diluted earnings per share. So the total, first we determine the option price, and the option price or the ordinary shares actually outstanding. Then we have the incremental ordinary shares, the option shares, and the assumed treasury shares. 3,000 divided by 75. So you get the ordinary shares of 210,000. Diluted earnings per share is computed based on 210,000. So number 1, basic EPS 7.5 million divided by 200,000, while we have if we include the option price here, we have the ordinary shares outstanding. Then we have to add incremental ordinary shares at the rate of here. Ordinary shares actually outstanding is 200,000. Incremental ordinary shares, option shares of 50,000. Then assume treasury shares of 3 million divided by 75. So 3 million divided by 75, or 40,000. So we get the amount for dilution of diluted earnings per share of 7.5 million divided by 210. So this time, the diluted earnings per share is 35.71. Then we go to 20-8, compute for basic earnings per share and diluted earnings per share. The operating revenue, 5.6 million. Operating expenses, 3 million. The income tax rate is 30%. Ordinary shares outstanding during the entire year is 200,000. At the beginning of the current year, there were options outstanding to purchase 40,000 ordinary shares at 25 per share. The average market price during that year was 20 per share. The entity reported 2 million of non-convertible bonds at year end. So we got uh, interest expense, and no, we get 10% non-convertible bonds. So this is supposed to bear interest. Interest expense is included in operating expenses. So in 20-8, we have the operating revenue of 5.6 million, the operating expenses of 3 million. So we have the income before tax of 2.6 million, the income tax rate of 30%, leaving net income of 1,820,000. So the basic EPS is the amount of net income after tax, 1,820,000 divided by 200,000. Now the outstanding shares of 200,000 at the beginning of the current year, you got the total options outstanding to purchase 40,000 ordinary shares at 25. However, the ordinary shares outstanding during the entire year is given at 200,000. So the basic EPS is 9.10. Second, we are going to compute for diluted earnings per share. The amount of diluted earnings per share is the same as the basic EPS because the share options are anti-dilutive. To be dilutive, the option price must be lower than the average market price. In this case, the option price of 25 is higher than the average price of 20. Accordingly, the share options are ignored in computing earnings per share. So, to be dilutive, the option price must be lower than the average market price. In this case, the option price of 25 is higher than the average price of 20. Accordingly, the share options are ignored because uh, they are again ignored in computing diluted earnings per share. So the bonds are also ignored because they are non-convertible and they never become potential ordinary shares. So the amount of diluted earnings per share is the same as in the basic because the share options are anti-dilutive. So we now get 20-9. In 20-9 again, we are asked for the basic EPS and the diluted earnings per share. The basic EPS is 3 million divided by 60,000 shares issued for the ordinary share capital. Then in number 2, determine the diluted earnings per share. So for the total option price of 20,000, that's the share options, and then we multiply it by 160,000. Now, as stated, the entity issued 20,000 ordinary shares. Actually, they're options because here we have the ordinary share capital issued is 60,000. But the option, the problem stated that on April 1, 2020, the entity issued 20,000 share options to employees, allowing them to purchase one ordinary share for each option at 150. The fair value of each stock option was is set at 100. and the average market price during the year was 250, and the ending market price is 250. The ending market price is 300. So we have now the option shares equal to 20,000, and we have now the assumed treasury shares of 3,200 shares. We multiply by the option, that's equal to the option shares of 20,000, and we have the assumed treasury shares. So the assumed treasury shares is taken by dividing 3.2 million by 250. So 3.2 million divided by 250. Now we get 12,800. So we have the assumed treasury shares, the cost, and you have 250 shares. So incremental ordinary shares 7,200, and multiply by 9 months, considering April 1. So we now get the incremental ordinary shares, and we have to multiply by 9 ordinary or the assumed treasury shares at 12,800, and then incremental ordinary shares 7,200 multiplied by 9 over 12. So we have the average incremental shares of 5,400. We are going to compare with ordinary shares actually outstanding of 60,000. So total of 65,400. Now for the problem 20-10, I suppose this is the last uh, straight problem because the rest are already in multiple type. So we have now in 20-10, on January 1, the beginning balance of 100,000 ordinary shares. Then on April 1, we have 50,000 times 9 over 12. All of the share options were exercised. The market price was 40. So we now have January 1 beginning balance of 100,000, and then actually 100,000 is given. Then we add the April 1 conversion. That's on April 1, all the shares were exercised. The market price was 400, so you now multiply 50 thousand shares times 9 over 12 from April to December. So the total ordinary shares is 137,500. So the basic EP is now is computed at 5,500,000, the amount of net income divided by 137,500, and that's the total ordinary shares. Then the proceeds from assumed exercise of options, 50,000 multiplied by 120. So for the exercise of the options, January 1, beginning balance 100,000 shares. Then on April 1, 50,000 we multiply by 9 over 12, April 1 na. So that's, you have 9 over 12 and you have incremental. So for the option shares, we add the option shares for the beginning balance. 37,500 is the result of multiplying 50,000 by 9 over 12. Just like the January 1 inclusion. So incremental ordinary shares, the option price is 50,000. Then we add the assumed treasury shares. We are adding 15,000 for the incremental shares. We have to deduct the weighted average. So that will be 12 million divided by 2,000. So you now get the option shares of 50,000. We deduct the assumed treasury shares of 6 million divided by 400. So the assumed treasury shares, we have now 6 million based on our ordinary share capital. So 6 million divided by 400. So the assumed treasury shares. So we have 15,000. Then we get the difference of 35,000. Now we have the incremental profit here, incremental shares, 35,000. So for the weighted average of 35,000 times 3 over 12, it's 8,750 for the total ordinary shares of 146,250. So the diluted earnings per share is 5.5 million divided by a total 146 250. Now that's 20-10 and 20-11. We already have the multiple choice questions. What amount should be reported as diluted earnings per share? In the problem, we have the ordinary shares outstanding is equal to 1.2 million. The ordinary shares outstanding is 1.2 million. So we have the ordinary shares to be issued in the acquisition of subsidiary is how much? How many units? How many shares? So we have 50,000 in connection with the acquisition of a subsidiary. In June 2019, the entity is required to issue 50,000 additional ordinary shares on July 1, 2021 to the former owners of the subsidiary. So the ordinary shares to be issued in the acquisition of subsidiary is 50,000. So the total ordinary shares is 1,250,000. The net income of 3.4 million, we deduct the share of the preferred stock. So we have now the difference of there computed, no, net income 3.4 million, then the preference dividend of 200,000 given. So the difference of 3,200,000 will be the net income to ordinary share, and we have the diluted earnings per share, dividing the remaining net income to ordinary share, and we divide it by 1,250,000 being the total ordinary shares. So 1,250,000. Now, for the net income, we get 3.4 million. We deducted or we divide for determining the basic earnings per share. However, in the problem, what's being asked for is diluted earnings per share. So diluted earnings per share is net income to ordinary share, and then we divide it by the number of shares outstanding of 1,250,000. Now you get 2.56. The answer is letter D. Then in 20-12, ordinary shares outstanding, ordinary shares to be issued for conversion of preference, 20,000 shares times 5, or 20,000 shares times 5, because in problem number 12 it stated that the preference share is 20%, 100 par, 6% cumulative convertible. Uh, Here we have in 20-12 ordinary shares outstanding given for 200,000 shares here given. Then 200, then ordinary shares to be issued for conversion of preference. We have 20,000, the preferred number of shares. So just multiply it by 5. So you get the total ordinary shares. And diluted earnings per share, 840,000 being the net income, and then we divide it by the total ordinary shares. Okay, now it's so hard, the rain is so hard and so loud. I cannot even hear my voice. So anyway, I'll give you the solutions to the remaining problems. I-share screen ko lang. So at least you will have a complete copy of that. So in 20-13, questions 1 and 2. 20-13. Then in 20-14. 20-14. So 20-13, questions 1 and 2. 20-14, questions 1 and 2. 20 does right. So next is 20 does 14, followed by 20 does 15, and 16, and okay. So that ends our okay. We have anyway, I'll just continue share screen sharing for the rest of the problems until the end of chapter 20. We are through up to 20-14 and 15, determining now in number 14 with 3 requirements. Then we have 20-15. Okay, let's continue with the 20-15. 20-15. Okay, i-share screen ko lang. Okay, 20-15, 16, 17, 18, 19, 19 with 2 questions, 20, 21, 22, we have 23, 24, 25, 26, okay, we have the theory, 27, 28, and 29. Now that's all for chapter 20. Tomorrow I'll try to discuss chapter 21. Convert. Okay.